Hi, I'm Simon Boughey, US editor of SCI, and I'm in New York this week for SCI's second Esoteric ABS seminar. Now, there's perhaps more innovation in this corner of the securitization market than any other, so I thought I'd take the opportunity to have a word with a few of the experts about where they see the market going. I began by speaking to Gary Miller, who's head of specialty finance at Revere Capital, a credit manager based in Texas. And I asked him, first of all, what type of esoteric asset classes have appealed to him lately, and why.
Yeah, I'm pretty keen on litigation finance these days. We've closed our first transactions in the last 6 or 8 months. With the uncertain economic environment we've had, over the last year, it's nice to participate in an asset class. It's kind of uncorrelated with the general economy. It's really about, exogenous economic factors. It's third-party liability. Someone's been injured. They got to get in the queue and, potentially get their day in court and get a settlement. And I also like it because there's a number of places to play kind of in that spectrum of time frame. So you have the plaintiff, an injured party who has medical bills or maybe is off work. So there are funders out there that will advance to the plaintiff. There's medical providers who are providing pain management services, surgery, imaging, and they're waiting for an insurance settlement, say, that might be 12 to 18 months down the road. So they like to get working capital to kind of finance those efforts until settlement. And then finally, of course, the attorneys have their fingers in the pie, and they have costs and expenses to run their firms. And so there are companies that lend to law firms, provide working capital to law firms based on these outcomes. And whenever you have these like large pools of financial receivables, you can kind of model underneath that. You can look at statistics and look at how many are lost, how many are discounted. The settlements are discounted less than expected, and you can use your structured finance toolbox to kind of model and structure a deal underneath that. So I think it's a fascinating asset class.
So how have the type of assets being securitized changed over the years you've been in the business?
Yeah, 20, 30 years ago, there were the big automakers, mortgage companies. I say automakers, they're captive finance companies and kind of more commoditized assets. And then subprime mortgages came along, and we had bond insurers back then. When anything was new, there was kind of a wrap associated with the issuance. I think with the advent of fintech, the lending industry is highly fragmented. You've got little pockets of people doing niche asset classes that with technology and APIs, they can kind of tap into platforms and originate loans in a cost-effective way. And they can do 20, 30, 40, 50 million a year in originations and be a very viable and profitable company. So as such, it's given rise to purchase order finance and all kind of pockets within the supply chain, merchant cash advance, anywhere where there's a pocket of kind of a contractual or anticipated cash flow stream off of a large pool of granular assets. And again, we can apply our structured finance math.
So what are likely to be the biggest growth areas, do you think, over the next year?
I think things will continue on generally as usual. An area of litigation finance, actually, intellectual property, is really catching on, and insurance companies are getting involved. And I think we're going to see, relative to other asset classes, probably a lot of growth in that sector.
And have the type of non-bank lenders you financed changed over the years as well?
Well, I kind of hinted at this earlier. It's really, you can have groups without brick and mortar presence, 5 to 10 employees, and they can be originating 50 million a year. And they're using technology and automated underwriting engines, and they can create, say, a national footprint, or they can have a bank partnership, to not have to go through the state licensing regime. They work with a bank partner to help originate the loans and then take them on their own balance sheet. So I'd say way more lenders / originators than you did 20 years ago, and it's really because of the technology.
Well, that leads us perfectly into the last question, which is about the private credit boom, which you're in the heart of. Now, are the good years set to continue, or will the traditional banks stage a comeback?
They're definitely going to continue. Absolute returns are great, higher than they've been in a very long time for, senior credit like what we do. I think the banks, they're going to be around and they're going to be players. I don't know if comeback is the right word. They're going to keep participating. It used to be a deal was either bankable or not bankable. Now there's just a deal, and then the different parties participate in the spots in the capital stack that make the most sense for them. So I think there's a lot more collaboration among banks and credit funds. Arguably, banks are lowering their, call it advance rate or attachment points in a structure, which maybe they should. But the private credit funds are there to take up the slack and provide junior capital, and so I see a lot more collaboration now than there was a few years ago.
So banks and private credit striding forward into the sunset hand in hand.
Absolutely.
Thanks, Gary. Thanks very much for joining us, and enjoy your day here.
So my pleasure. Thank you.